An interval fund, being a registered fund, shares some of these features of other registered funds like mutual funds. But the differences and some of the risks that investors kind of have to think about come with the fact that you're opening up your portfolio to a wider set of potential investment strategies. And that can range from real estate debt, real estate equity, to things like private equity, venture capital, infrastructure, or other types of real assets. And these are long dated assets.
I guess A, let's start with what is an interval fund? And then B, what's the number one secret to investing in it?
Sure. So an interval fund is a type of SEC registered investment fund. Another type of registered product would be a mutual fund or an exchange traded fund, which you're probably already very familiar with. Interval funds have been around since the 1980s, but it's really just been in the last 5 or 10 years that both alternative investment managers and some large traditional asset managers have been using these structures to make less liquid or illiquid assets available in this type of fund format, which makes it easier both in terms of investing in funds, but also in terms of monitoring your investment or just even receiving a 1099 tax form at the end of the year. So an interval fund, being a registered fund, shares some of these features of other registered funds like mutual funds. But the differences and some of the risks that investors kind of have to think about come with the fact that you're opening up your portfolio to a wider set of potential investment strategies. And that can range from real estate debt, real estate equity, to things like private equity, venture capital, infrastructure, or other types of real assets. And these are long dated assets, highly illiquid. If you're thinking about a commercial piece of real estate, or if you're thinking about a toll road or a pipeline or something of that nature, which might find its way into a infrastructure portfolio. But the benefit of these alternative or less liquid assets is that they can be put together into a diversified portfolio, and asset managers can deliver benefits to investors, potentially higher returns or higher yields than stock and bond investments.
Got it. So it sounds like there's a less liquid or completely illiquid assets that are pulled together into a fund that someone can invest in as a whole to diversify between these less liquid assets. Is that a fair summary, Kim?
That's right. And the name of the fund, interval fund, it refers to the frequency of liquidity that shareholders might have if they wanted to exit a product. And so you can invest in interval funds. Many of them you can invest on a daily basis. You can go into the interval fund, but the exit is limited because you can't have all investors wanting to pull proceeds on the same day if the underlying portfolio is less liquid or illiquid. And so the interval fund speaks to the predetermined period by which most funds on a quarterly basis will allow some portion of liquidity. And then that gives, I think, investors who are going into a new product a sense of, okay, well, this is a medium or a long-term investment, but it gives them a sense of how much liquidity they might be able to secure if they wanted to exit or reduce a position.